I'm Evan Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, we teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.
Good morning. My name is Scott Redler, Chief Strategic Officer at T3Live.com.
And I'm Brittany Umar, and together we bring you Morning Call. So world markets, as well as our futures, are reacting positively to the news this morning that Larry Summers has withdrawn his name for the race to be the next Fed chairman, paving the way for the more dovish Janet Yellen. So do you think this will be what puts us back above 2013 highs, Scott?
I think it's going to get us there a lot closer than some would have thought. But overall, the market's been acting much better since late August and during September. A lot of people were, putting the doomsday thesis out there that September tends to be the worst month. We have all these things against us. People were even saying 1987 style crash. We're back in 2008 again. A lot of irresponsible things. So what we tried to do is just focus on the fact that we've been following trends, and as long as these trends stay intact, let's drown out the noise. And I'm not saying like today is a noisy day, because it definitely means something who's going to potentially be our next chairman, but this is adding a little bit of fuel to the pain trade if people are short, and it's also getting us to those highs a lot quicker if some people don't have enough risk on. So it's creating a pretty interesting dynamic.
Right. So why don't you show us a visual then so we get a better idea of the levels you're watching?
Let's do that. So you go to the chart of the SPX and you can see that here is where this trend started in November. There you go. Okay, we tested it in June after this outside day in May and this 4.5 or 5% correction. Then we had this head and shoulders top, corrected again. But what do? We held this trend line. And if you take a closer look here, you will see, yes, it did look as if perhaps we could have broken and closed below it. But did we? No, we did not. So this was a spot for adjustments around 1641. If you missed that spot for adjustments, there was one when we crossed back above this trend line here, reclaim the 50-day. And if you did so here, if you were short thinking that we're going to break, you know what, you maybe took a small loss, but if you didn't cover your shorts at 1664, now you have a bigger headache up here at 1700, and that's why they call it the pain trade. And if you took some risk off or you don't have a lot of risk on, this little bull flag formation probably should have given you some clues to be long a little. So, if you're a chaser here, that also is going to create an interesting dynamic. So overall, it feels like that's been the interesting dynamic of all of 2013, that when they go fast and you have to jump on. And if you're short, you cover. And if you want exposure, you got to pick up the best acting stocks and sectors.
Right. Well, we know that the Fed begins its 2-day meeting tomorrow on Tuesday, and we're, of course, going to be awaiting the answer to the big question, will the Fed taper? We'll get that answer on Wednesday. So do you think that could ultimately be puts us back off track, or is that already priced in?
I think the street's pricing in at least $10 billion reduction in the pace of purchase. I'd like to see maybe even a little bit more than that, closer to 15 to 20. But overall, I think Big Ben wants to get the ball rolling. Okay, so 10 billion. I think it's going to be, the same market composure is going to persist. If they go 15 to 20, maybe the market gets a little scared, but I think overall, the market will like that and we can hold in there. But there's a lot of trading between now and Wednesday. We'll see where we are, but this, Summers dropping out of the race is not going to change the Fed's communique on Wednesday, which I think he is ready to start reducing that pace of purchase.
Well, in looking for opportunities, we've talked a lot about the 2013 theme of going long the TBTs, and as rates have pulled off a little bit, is that providing opportunity, or has that theme changed at all?
I don't think that thesis changed. I just think the speed sometimes changes, and it's been pent up the whole way. And I think some who use a tier system might be in like a tier 1. Some who trim and trailed a little too early looking for a way in. I think this is your way in. It may not be perfect because of the volatility this week, but it's September. You look at the chart of the TBTs. In my humble opinion, here we're going to be opening near the 50-day. It's worth a look for active guys. But if you're a more macro individual and you have bond portfolios, and you're like, oh, I think rates go higher, how do I, make a little bit of money along the way? I think if we happen to go even a little bit lower, which I don't really think so, this would be a zone to put some TBTs on or back on or just accumulate, because I do think, if maybe the 3%, which we talked about coming to a theater near you in 2014, actually happens in 2014.
Right.
Doesn't happen in an accelerated pace like everything else that's been going on this year.
And what about gold? We saw gold close strong on Friday, but it's not gapping up today on the news. So is that opportunity there? Do you think it's weak?
I think it is weak, and I think that there was a little reversal, and I know that I was trying to play the little reversal on Friday, and I was like, oh, I didn't take it home. It's going to be up big, and then I looked at it this morning. I'm like, it's not up that big. So I guess people aren't thinking that they're going to be off the the course of reducing the pace of purchase just because it could be yelling again. It could be a little different type of speed, but you look at the chart of gold, and overall, it's been in a really big downtrend, okay, ever since the high here in May. Here's your high, here's your lower high. This was your 160-ish area for one adjustment to take some risk off here or maybe get short. Here is when that macro support gave way, spot to get out of the way. Another nice trade right there. And then we had those blood on the street lows, if you remember. Okay, that was a nice little trade. Then there was another additional long trade tactically above this, 129, 130, and then it started to get a little weaker. Okay, some are thinking that this could have been, your pivot low, and I guess it might be still, but today you'll watch it's opening lower. If it holds above 126.21, stay with it if you think this gap gets filled, but if it breaks 126.21, I just get out of the way. This to me is a broken trend and very hard to navigate, very random. Lots of it happens overnight. So unless you have a particular really strong gold thesis, just trade the charts and not opinions, because a lot of gold bugs have been bugging out all year because they had opinions versus seeing the trends, to the downside persist.
Right. Well, there were clues that we could have picked up on along the way that we were going higher. Let's check the temperature of the sectors from going strongest to weakest. We were, of course, led the way by biotech, the best performing group.
Yep, IBB. Take a look at the chart. You'll see, at 2013 highs, in the last 2 weeks, well before the S&P, and here we are flagging again, a trade and close above this 207.78, and no reason why it can't continue as long as it stays above the 8-day moving average. You could see the action fast here.
And technology as well at 2013 highs before the S&P.
Yep, another sign that at least if you're trying to short other spots, have a little short off the brain, because when technology leads the overall market, that shows signs of growth. That's healthy. That's what traders like. And if you look at here at the Qs made 2013 highs last week or maybe the week before, whatever, and then digested above it. Well, if you take a quick look at the spiders, look where they are. Spiders are hovering below. Qs are hovering above. So right there, technology is helping lift the overall markets and make sure that trend continues as it looks like it is.
Energy as well, hovering near highs and holding above the 8-day for the past about 2 weeks.
Yep, and this was was different because it wasn't a leader for the majority of the year and then regrouped and got some relative strength. And you look here at the XLE and it's above the 8-day. It's been above the 8-day ever since breaking above this area. Yeah, hasn't been that powerful, but it's still moving higher, still above the May highs and the summer highs, and looks like it's going to get going again. So another group at highs before the S&P, giving you clues not to be short the S&P or some other areas.
And we like to watch the transports as well, and the transports found good support at the 8-day on Friday.
Yes, and you can't be in everything, but you could look at a lot of things for certain clues. And for me, I don't always look at everything just because one thing diverges with another, and then you think too much and all these type of things. But overall, as you go through these charts, lots of them are above their 8 and 21-day moving average. Lots are a stone throw away from old highs, so lots of opportunity. And you look at the transports here, right above the 8-day. Yes, some are like, oh look, the transports filled the gap. The market's weak. Didn't really fill the gap. It came in, held the 8-day, and still looks just fine. Just not as strong as some other things with oil where it is. So anyway, lots of things to continue to maneuver. Right.
Well, and financials may not be at 2013 highs in one of the best performing groups, but it's picked up some lost momentum, helping us get us back on track.
Yeah, well, this group gave us some signs, okay, when we were near that pivot, right, on the S&P, that maybe this time could be different. Okay, so maybe it could have, but was it? No. Okay, it was below the trend line, then it came back above it and reclaimed it. That's what you look at these trend lines. That's why we always say, even with like the 200-day, something breaks below the 200-day. My rule is if it doesn't reclaim it in 2 to 3 sessions, it's that weak, and it's probably going to continue in that direction. If it reclaims it quickly, it was more of a trap. You look at the financials here, it did break below, okay, the trend line here that was set all the way back from May or even here from November, okay, but it reclaimed it, okay, then gapped above it and held above it, and as of right now, looks like it's going to, be in line. It's not outperforming like it did the majority of the year, but there's other sectors that have picked up the baton. So right now, it looks like the XLF is going to open above 2030. And, there's those highs there. So we'll see, what the next move for this is. But it looks like it's upside.
And the home builders, weakest of these groups, but does seem to be acting better.
Yes, and, you had an igniting bar that that put this group back in focus again. So if you look here at the home builders, yes, this group, just like the financials, not leading and could have been a big-time headwind, okay? But if you look across the board here, you'll see this major support held. Okay, and then you had an igniting bar. And we talk about igniting bars because the name of this pattern is for a reason. Igniting bars could ignite a new move, okay, or a new trend. And this is a pretty potent igniting bar. And more importantly than that, it actually held higher. It held the top third of this, showing commitment to this move off the lows. And now I would think that this group's going to probably get a little extra love because with Yellen in there and rates coming down, they'll think that home builders could be back on track. And then here are those old highs. But ultimately, we've been talking about this for over 2 years now. And, it's been a heck of a nice trend. Okay, and these are just extended lines from this. But with that being said, there's been a lot to like there. And, and it still looks like there's a lot to continue to like, but the speed does change.
All right, well, coming up, we're going to go in the trenches with some stocks on the radar, but first a quick commercial break. We'll be right back.
I'm Mark Sperling, Director of Trading with T3 Trading Group and contributor to T3 Live. Do you trade on your own, but you wish you enjoyed the benefits of a large trading floor? With the T3 Live virtual trading floor, we deliver that experience to you on your computer. On the VTF, you can follow the long and short positions of experienced professional traders like myself, Scott Redler, and others, and listen to our live radio stations as we navigate the markets. In addition, you get the added value of a large community of sophisticated and like-minded traders. Your membership to the virtual trading floor also includes access to our 2 very popular newsletter products, Off the Charts and the Price Point Sheet at no additional cost. In my opinion, joining the room will be the best trading decision you will ever make. I would like to invite you to begin your membership with a 7-day free trial. To get started, visit t3live.com and click on the Virtual Trading Floor tab. Have a great day, and I look forward to seeing you in the VTF.
We're back and going in the trenches with various stocks on the radar. Let's start with Goldman Sachs. Scott, I know you seem to like a new potential setup in Goldman Sachs after Morgan Stanley already hit 2013 highs.
Yes, and last week I was trying to look at things that gapped up, digested, that could have continuation. And you could have done it 2 ways. You could have said, okay, while it's in this flag type pattern, I'm going to buy a little, and then I'll hopefully be able to buy more as it gets in motion. So for me, I bought a little Goldman Sachs, hoping to be able to buy more, but anybody that was hoping to buy things at the right price point today, probably are discouraged because it's opening well above all of these. But anyway, you look at Goldman Sachs and you'll see, it held support, gapped up above the moving averages, let them, catch up. Still looks good here. If it were to get above this 165.79 and hold above it, I don't think these. Ultimately, I think they take these out. It'll just happen a lot faster. Look at Morgan already above, hovering above, and it'll probably be opening up a new, 2013 highs itself.
And Exxon, a laggard name, put back on the radar on Friday after the stock appeared to find some good support at 86.50. So we're looking for a potential bounce back here.
Yes, and I'm 0 for 3 in this stock. I've tried it a few different times and have so many little false starts and doesn't show commitment, where finally this time looks like it could be a little different. You look here at the chart of XOM, it's held really big support. If you got out of it here on this like false breakout or got out of it here, you have the luxury of trying it again. I'm not sure where it's opening right now, but it does look like it's going to try and get through this 89 and get back to these moving averages. I was hoping to, be long some, which I am now, and buy a lot through 89 for a trade, but it's probably going to be opening above it, and we'll have to just see if it's buyable after the open, which unfortunately with these big gap ups in the market, it makes that trade tricky if you want to put on intraday risk.
Well, and I know Green Mountain is also on the radar, building an upper level base above its 21-day. Is it gearing up, do you think, for a breakout?
Looks like it. The range is tight, and GMCR doesn't love to have a tight range. And if you look here at the chart, You know, here is the last breakout. Nice little consolidation above the prior breakout. So, you know, it has to get going with volume. So above 86.75 or 87-ish, perhaps it gets in motion for another move. So you have a tight setup here. But again, a lot of these tight setups are probably going to be different after today's market open.
Okay, well, we'll also be watching Zillow. All key moving averages have been rising up. What do you think here?
This is one of those thin speculative names where I'd rather buy high and sell higher versus accumulate and wait. You know, last week it did a little bit of a false breakout, but it's still hanging in there. You could have it on the radar. It's, you know, hanging on to the 21-day. It's hung, you know, it's been above this really since July. So as long as it stays above this, you know, I guess with a certain amount of time it can go again. Just be a little careful here. It's very thin, and sometimes, you know, the floor could fall out, and then you're caught having a lot of risk.
And some nice recent moves out of VMware as well. What do you think here?
Well, we started talking about the stock like a month ago. I remember for the whole year we really didn't talk about it. Then it started acting better, and now, you know, it's continuing. You look here at VMW, you'll see that had a really big gap up, right? This was right here. Okay, if you remember, we were talking about it here. You know, it gave you a little bit of a trade, came back in, and it still doesn't move with a lot of fluidity, but it's acting okay. And here's a little flag pattern on top of this. So above, you know, 89.36 looks okay. It's above all the moving averages, and it's, you know, still in the game for some higher prices.
All right, time for some quick hits. Let's talk Apple. Sellers we know stepped in on Friday, closed around its 50-day. So
I don't know, this is something that maybe some traders took home short because it closed on the dead lows, you know, but then they also had to think about what kind of numbers would come out about the, you know, the 5C, this and that. You would think, you look at the futures up, you know, if Apple was really healthy, it would probably be up 6 or 7 points, not 2 or 3. So with that said, some traders might try and, you know, short this up open. We'll see. You look here at the chart, you know, this is when, remember that, you know, the nice pent-up move that we had ever since earnings and breaking above this 445, that was a lot of fun. Then the trade changed on the invite day when it broke back below 503.50. That's when I got out of my, you know, potential swing long. And then now here it's in the slower range, hovering on the moving average. So with that said, it closed on the dead lows Friday, so one of the rules is, you know, if the futures are up and something's up because of the futures, look at it. If you see a negative divergence, you know, maybe you shorted and below this, you know, it sees more downside. But, you know, Apple sometimes traps you, so just don't have fully short on the brain here because of this bar. You know, make sure that you get that real weakness there. And if it does hold in today and continues to go sideways, you know, we'll see how it handles this gap. But for right now, it looks like, you know, pressure's more on than off.
And Tesla, upside momentum has been slowing down a little bit, but it has been hanging above its 21-day. So what are the key levels you're watching here?
This one I was hoping, just like a lot of other tight patterns, that it would be flat and I could trade it through a price point. And if you look here, you know, look at this tight formation. I know Elon Musk gave us a little bit of a scare telling people that it wouldn't be such a crazy thing to short a stock. But anyway, it held in firm. I was hoping to be able to buy this above 168-ish, you know, for a move to take out the 2013 highs. I think it got an upgrade today. We'll see. But overall, this has been tight. And whenever this is tight, you know, typically it's been a move to the upside. Here was tight, move to the upside. Here was tight, you know, move to the upside. So here it's tight again, and it's holding the 21-day, and we've talked about this stock many times. As long as it stays above the 21-day, don't listen to the naysayers, stick with the trend.
All right, so what will you be focusing on as we begin the trading session today?
Well, I come in with some long exposure, but not a heck of a lot, a little flat-footed. You know, I'm not looking to just short the open. I'm looking to see if, you know, some things could continue to be viable, you know, versus some of these resistance areas. I do think that it'll be interesting to watch the dynamic of rates and gold. You know, gold probably should have been up and it's not. So rates are, or the TBTs are down a little bit. So I still think that's viable. There could be a little bit of an overreaction there. And just try and stick to the trends. You know, a few weeks ago when Syria was blaring up, everyone was saying, should I get out of the market? And we were talking, I'm like, listen, if you survive 1987, survive 2001, and survive 2008, you're going to survive Syria. Okay, stick to your macro plan, especially if it's, you know, you have a long time ahead of you. Don't just pull out here. And if you have an intermediate or an active plan like we try and do to, you know, create P&L and a living, stick to it as long as the trends continue. Drown out the noise and look at the price action. That'll get you a lot further than listen to the fearmongers.
And with that said, happy trading, everybody. Have a great day.